Good afternoon, everyone. Am I audible?
Yes, ma'am.
Yeah. So, in the earlier class, if I'm not wrong, this was your syllabus, and out of this is your syllabus. If I'm not wrong, is this the same syllabus that has been shared to you and even shared to me? So, and here, if you look at here in block one, these are the different types of different units. It consists of 7 units. In that, we have done with the 1, 2, that is basic concepts, income exempt from tax, income from salary, host property, business and profession. And we were to complete the remaining parts. So because these are a little for problematic chapters where you need to practice it. So that's the reason I was more concentrating on these chapters. So if you look at this income from capital gains, so let's understand income from capital gains and other sources. Remaining all chapters, most probably that will be of theory part. So I'll just start income from capital gains. So if you look at your income from capital gains, it's nothing but whenever you actually should know the different terms that are capital assets. So again, in capital assets, we have short-term capital assets and long-term capital assets. As we know that asset means anything that benefits the organization in the long period, and capital assets means which may incur or generate the income. You will be investing one time in that type of assets, such as land, buildings, any agricultural land, house, if you're constructing any residential house or any plots, this all comes under the assets. So again, under assets, we have long-term assets and short-term assets. Long-term assets and short-term assets. If you are holding any asset for more than 36 months, for more than 36 months, it is called as long-term asset. And if you are holding any asset which are for less than 36 months, they are called short-term assets. But in case of shares, securities, bonds, debentures, if you are investing in this type of investments, shares, bonds, debentures, securities, if you are investing in this type of assets, and if you are holding this type of assets for more than 12 months, if you are holding shares, bonds, debentures, or any securities for more than 12 months, they are called as long-term assets, long-term capital assets. The same, these shares, bonds, debentures, and securities, if you are holding less than 12 months, they are called short-term assets. So only case of this type of securities, it will be called for 12 months. More than that, it is long term, and less than that, it is short term. So whenever you purchase the house, and if you are selling any house, if you are having any agriculture land or any plot, any building, if you are selling that, maybe that house you might have purchased in 1990 for 5 lakhs. The same house, today if you are selling, it won't be 5 lakhs. It may be 1 crore or above that. So whenever you're getting that gain out of selling that property or that asset is called capital gain. It is called as capital gain. So whenever it is capital gain, it's our responsibility to pay the tax on whatever income we are getting from that capital gains. So how to tax it? Is it justified with the property which I purchased in 1990 for 5 lakhs? The same property for 1990 lakhs, I have in 1990 for 5 lakhs I have purchased. The same property or the same land or same building, if I am selling today in 2003 for 1 crore, 2023 for 1 crore, then is it the real profit what I got? No, because again, same with 5 lakhs, I cannot purchase the property today as of now. So how to make it? Whatever 5 lakhs I have purchased in 1990, if the same value I bring it to the present date, what will it be? Its value. Will it be 5 lakhs or 50 lakhs or above 1 crore? So I will bring this 5 lakhs, whichever I purchased in 1990 for 5 lakhs, if I calculate it with index numbers, and I'm bringing this 5 lakhs to the present date, because rupee value changes every day. It will not remain as it is. It fluctuates. So when I'm bringing this 5 lakh rupee, in 1990 it was 5 lakh, but now its value may be more than 2 crores also. So how to get that? By doing indexation. We call it as indexation, means bringing the 5 lakh value presently, what will be the value. Why? Because this 1 crore or 2 crore may be market value. Whenever you purchase any residential house or any residential property, agriculture land or any plot, any building, you will purchase as per the market rate. You will not purchase as per the government rate. So now we will bring this 5 lakh rupee, what it will be the present value if I purchase the same land or same house. So whenever I sell some property, that is called as sales consideration. Means I'm selling my property, selling my land, selling my agriculture land, or selling my building, or selling my house, or I'm selling my plot. Whenever I sell, whatever amount I get by that selling that property, that is called as sales consideration. It is called as sales consideration. Sales consideration means whatever amount I am receiving by selling that property is called sales consideration. But do I sell directly to, for example, I am X, I want to sell my building. I cannot go each and every person and ask, will you purchase my house? Will you purchase my building? No, I cannot ask like that. So what I'll do, I'll take the help of some broker or some person who involves in that type of business. For example, real estate business person or some broker who involved in that type of selling the houses. I consult them. So whenever I consult them, they charge some charges to me. They are not going to provide me any services free of cost. So what I'll do in that case, I'll take the help of that brokers and I'll try to sell my house. So they are not going to provide me free services. I have to pay them. Whatever charges I'm paying towards them are called brokerage charges or commission. And if Y is ready to purchase my house through broker, I came to know that Y is ready to purchase my house. But whenever I'm selling my house, is it as easy that I can sell? No, it is not like that. Why? Because whenever I just cannot go and tell why you take my house property or take the papers of my land. No, it is not like that. I have to go through some procedure. So I have to transfer registration office. We do registration charges. That is called transfer expenses. Whatever expenses incurred to transfer our property to Y, that are called transfer expenses or selling expenses. So whenever we receive something by selling our land, from that we will deduct our expenses that are called transfer expenses or selling expenses. Whenever you deduct from sales consideration all the expenses incurred, and the difference we get is net sales consideration. Net sales consideration. But I cannot pay the tax on total, say, whatever amount I received. Why? Because to now whatever property I am selling today, might have purchased earlier. So that rate should be deducted. Sales price minus cost price. I will get gain. So how to find out gain? I have to deduct my cost price. So I will deduct my cost price. Less. We call it as, whenever we, as I said, we have long-term capital assets, short-term capital assets. Whenever you sell long-term capital assets, you will get long-term capital gain. And whenever you sell short-term capital assets, you will get short-term capital gain. So this indexation, as I said, bringing the amount of which was there in the earlier 20 years or 30 years back, bringing to the present date is called indexation, I said. And indexation is done only to the long-term capital assets. Indexation is done only to the long-term capital assets. So here long-term capital assets only will do indexation. So whenever we are after getting, as I said, sale price minus cost price. So cost price is called as cost of acquisition. Cost price is called as at whatever price you purchased that property earlier. That cost is called cost of acquisition. This is for short-term capital asset. If it is a long-term, a word will be added here. Indexed cost of acquisition. Indexed cost of acquisition. Then how to find out this indexation? I was telling that we have to bring the value of the past to the present. How? With the help of index numbers. We call it as index numbers. And these index numbers are given in the textbook. So we'll do with indexed cost of acquisition. Sometimes what happens, though rate has increased. For example, you are having 150 square yards of land. Whatever years, maybe 100 years, 20 years, 30 years or 50 years. The land is not going to expand by 1 inch also. Yes or not? It cannot be expanded. But its value is going to increase. So what happens? Sometimes the houses become old. We want to renovate it. You want to have one more floor to that building. Or you want to construct another room in the same place wherever you are having extra room. Or you want to construct some wall to your house, total surrounding wall. Gate, you want to change it, paints. So you have improved your house. So whenever the improvement charges are taken, that is called cost of improvement. You want to sell your house which was 50 years. 50 years earlier when you purchased house may not be the same as it is presently. So what you will do to make it new one, you might have incurred some expenses, painting, making all repairs, or that all charges are called cost of improvement. For short-term capital assets, we write only cost of improvement. For long-term assets, we write indexed cost of improvement. Indexed cost of improvement. Then how to do this index cost of improvement? With the help of index numbers. With the help of index numbers. It's very simple to do the indexation. How to do that indexation? Indexation is simple. Whenever you are doing indexed cost of acquisition, whenever indexed cost of acquisition is done, fair market value of that house, indexed cost of acquisition means cost price, nothing but the cost price. And indexation is done only for the long-term assets, not for the short-term assets. Why? Because short-term assets means if you take land and all those things, it will be 3 years, that is 36 months. And if you talk about shares, debentures, that is of 12 months, within less than 1 year. So it won't be that much change in the short-term capital assets whenever we take. That is the reason we will not take the indexation. Only for long-term capital assets, we take indexation. Why? Because long-term means it will be more than 3 years, and normally we will not sell our house or any property within a period of 3 years as soon as we purchase it. May not even less than 10 years we will not purchase. Most probably the middle class people, the middle class income people will never sell their property so easily. So it will be there for more number of years. That is the reason we go for indexation. So whenever you want to find out the indexed cost of acquisition, fair market value of that property or that asset, or cost of acquisition of that asset, or cost price of that property divided by CII of the year when it was purchased. CII means cost inflation index. cost inflation index. Indexation I said na, index numbers. Why? Because rupee value changes. There is a lot of change in the money value. So it is called cost inflation index. Of the year when it was purchased, I said 1990. So that 1990 year we have to take the index number over here, 1990 year. Into CII of the year. CII of the year when the asset was transferred. So when asset is transferred, yes, I'm audible.
Yes, ma'am.
Yeah. So here CI of the year of asset transferred means here our assessment year is 2022-23. And our previous year is 2021-22. So in our previous year, here transfer will be 21-22 only this year. Previous year transfer only that we will charge in our assessment year. So here CI of the our previous year is 21-22 and it is remain same, that is 317. Our previous year index number is 317. So let's look at that, how they look and how to do that problem. Let's look at, and whatever difference we get, if it is a gain, we have to pay tax on that. But it is not justified to pay tax on whatever gain we are getting. So in order to that, income tax department provided us some exemptions. For example, if you have sold your residential house and out of that house, whatever gain you got, if you're investing the same amount in purchasing the another new house, then that amount is exempted from tax liability. So please look at that. So this is what they've given, kinds of capital assets, long-term assets, short-term assets, and transfer of capital assets. Computation of capital gains. So you can just look at here. Is it visible?
Yes, ma'am.
Yeah. So this is how we calculate cost. Indexed cost of acquisition shall be computed. Cost means fair market value or cost inflation induction of the year in which the asset is sold. Here it should be into, not there actually. It should be here. This should be here. The cost inflation induction of the year in which the asset is sold. It should come over here. And cost inflation induction of the first year in which the asset was sold means when we purchased our asset. Cost of asset, when I said na 1919 I purchased the asset. So that year index value will be taken here. And here previous year is 317. You can just look at here it is given. Okay, here till maybe in your textbook they might have given.
It is given.
Is it there?
It is there.
Yeah?
It is there, ma'am.
21-22 it is 317. Yeah, it is 317 if I'm not wrong.
Yes, ma'am.
Yeah, that is our previous year. Means whatever income we earned in the previous year only, that only we will do in our assessment year. We will not do if it is sold in some 2020, that will not be taken over here. Only previous year transactions or whatever income we got in previous year, that is taxed in the present year. And for calculation, all the time you have to remember 2001 as the base year. 1st April 2001. So whenever if any asset is purchased before 2001, as I said 1990, am I right? So whenever if it is 1990 is given in the question, then what index value should be taken? Because if you look at your table, index table, whatever given to us, it is starting from 2001 only. Yes?
Yes, ma'am.
Yeah, then how to take then? In that case, whenever any asset is purchased before 2001, its indexed value will be 100. Its index value will be 100. So here in this formula, my cost of asset, what I said, 5 lakh rupees I purchased a house. My asset value is 5 lakhs. And when did I purchased? 1990 I said na. 1990 means before 2001 it is. Whatever it is before 2001 I purchased, I will take index value as 100 only. Why? Means this is the rule. See, here if you can look at here, cost inflation index for the first year in which the asset was held, or cost inflation index on 1st April 2001. Whichever is later, means before that it will be taken 100. After 2001, if you have purchased any house, here index values are given, that we will take it. These are the different index value if in that year if you have purchased any property.
So ma'am,
But
so
any
means ma'am, we have to remember these index values, ma'am.
No need. Only you remember the previous year index value.
Okay.
Why? Because remaining all they will give in the question itself. Only previous year index will not be given. That's it.
Okay.
So you have to remember our previous year index value is 317. So into here 317. When the asset is transferred, it will be transferred in our previous year only. So we have to remember only this one. And after doing this, whatever value you get, that is called cost of acquisition. Means which I purchased in 1990 is not now 5 lakhs. Its value is something different. So if we do 5 lakhs divided by 100 into 317. So if I want to purchase that house, now it will be like 15 lakhs 85,000. That is not actual rate. That is government rate, we call it as. Because market rate will be totally different. So from this will be deducted from the whatever value I am selling. Next we have indexed cost of improvement. Improvement, any addition that has been made to our property is called cost of improvement. Similarly, if cost of improvement is done to that particular property or that asset before 1st April 2001, if you have done any improvement to that property or that house or that building before 1st April 2001, in that case, cost of improvement will be ignored. It will not be taken. It will not be taken. If you have done any improvement to that property before 1st April 2001, it will not be taken. If it is after 1st April 2001, then this formula is applicable. That is whatever cost of improvement I incurred divided by in which year the improvement has been taken place. Means for example, if it is 9 and 10 year improvement taken. So 9 and 10 improvement value is 148 index number. Improvement, I have spent 2 lakhs to that house to construct new room. So 2 lakhs is the value of improvement I have done divided by in which year I did? I did in 910. So 910 value is index number is 148 and previous year index value is 317. And then we will deduct from the whatever sale price and whatever difference we get, that we call it as long-term capital gain. Long-term capital gain. So now let's look at that. If you can just look at these are different assets. No, not this one. Yeah, I can just look at here. From the following information, compute the capital gains for the assessment year 22-23. Date of purchase. Is it the same years they mentioned? Please just look at your question, textbook, if it is there.
Yes, ma'am.
If any change, what is the year they mentioned?
Ma'am, they mentioned the year May 1997, December 2000.
Okay, same it is.
May 1999, sir.
99?
97, madam.
97, 2000.
Okay, assessment year given you in your textbook?
Assessment
No, ma'am, it is not given.
indexation is given for up to...
No. First line. From the following, if you can look at this question.
From the following information, compute capital gain only.
For the assessment, they didn't mention.
No, ma'am.
This is not there in your textbook?
No, ma'am. Only the question is asking from the following information, compute the capital gains. That much only.
Okay, that's it. They didn't mention the assessment year.
No, ma'am. They did not mention that.
Okay. So, just if you just look at here, date of purchase they given May 1997, house 1 and house 2 it is December 2000. Both are before 2001 only. 1st April
Yes,
2001 only this has been taken place. And cost of acquisition is given, means the rate at which I purchased that house. One is 1,90,000 and the other is 2,50,000. Cost of additional construction in 2000 means nothing but cost of improvement. A house 1 10,000 and house 2 is 25,000. Fair market value on 1st April 2001, 1,75,000 and 3,50,000. Cost of additional construction in 2014-15. So in 14-15 also they did the additional construction. So it is nothing but, this is also cost of improvement only. 51,800, 77,700. Sale proceeds of the property in 2018-19, 20 lakhs, 60 lakhs. So cost inflation induction, they have given the index number C. Like this, they will give in the question. So not
ma'am, in our question, sale proceeds of property in 2001, 2002 is given.
This one?
2020, 2021, 2022. Yes, ma'am.
Means our previous year. Our previous year they given.
Previous year. Okay.
So,
actually, madam, before 2020, actually before 2021 is purchased, so we have to difference between fair market value.
No, please, listen. So here the index sale proceed is 21-22, which is our previous year. So whenever you do, first we'll start like this. We draw a table and one particular column, 2 amount columns, particulars, and starts with sales consideration. Sales consideration. And first we will do house 1. House 1 sales consideration is how much given to us here? It is 25 lakhs. House 1 sales consideration is 25 lakhs. So sales consideration 25 lakhs. If you look at the question, did they given any transfer expenses or selling expenses to us? No, they have not mentioned any transfer expenses or sale expenses. But as per format, I will write less transfer expenses, not given in the question. So that will be hyphen and I'll get a difference of 25 lakhs. This is called net sales consideration. This is called net sales consideration. Now, from this, we will deduct indexed cost of, because house and they purchased in 1997, so it is more than 36 months. So whenever it is more than 36 months, we call it as long-term capital asset. Whenever it is a long-term capital asset, we have a indexation. So under that, first one less indexed cost of acquisition. Indexed cost of acquisition. So what I said, if you are purchasing any house before 2001, I will not take cost value of the asset as it is. I will compare it with fair market value. If you look at here, cost of acquisition of house 1 is 1,90,000. Fair market value is 1,75,000. And this house was purchased before 1st April 2001. So whenever it is like this, out of these two, whichever is higher, either fair market value or cost of that asset, that will be taken as cost of the. And if you look at here, cost of acquisition is only more. Yes or not? Why? Yes, because fair market value is 1,75,000. Cost is 1,90,000. So which is more? 1,90,000. So I will take 1,90,000 divided by, in which year we purchased? 1997. Means before 2001. So whenever it is before 2001, the cost means here I will assume that the asset is purchased and index value I will take as 100. Why? Because if you have purchased before 2001, there are no index values. So we take 2001 only as the base year for that. Into, in which year we sold? In the previous year, not 21-22. So 21-22 index value is what? 317. 317. So just calculate 1,90,000 divided by 100. into 317. It comes to 6,02,300. Is it so? Next one. Indexed cost of improvement. Why? Because there is improvement also be done to the house. If you look at here, we have done 2 times. One is in 2000, we have done improvement, and another we have done in 2014-15.
14-15.
We done twice. We did twice to the improvement to the house. And this first improvement I will not take. Why? Because whatever improvement done before 1st April 2001 should be ignored. That is the rule. Now, this improvement is done in which year? 2014-15. So this will be taken for the deduction or exemption. So indexed cost of improvement is equal to, what is the cost I incurred for the improvement in 2014-15? 51,800 divided by, in which year 14-15 index value is how much? They given here in the question. 14-15 index is 240 into, when we have sold in 21-22. So 21-22 index value is how much? 317. So now it comes 51,800 divided by 100 into 317. It comes to 1,64,206. Is it right?
Ma'am, you did, I think 51,800 divided by 240, na ma'am? I think you did 100.
Yes. Sorry. Yes.
This is the
317. 68,419.
68,419.
419.
19, ma'am, 90.
19.
Oh.
68,419. So if you add both the things and deduct it from 25 lakhs, 68,419 plus 6 lakhs, 2,300. So 6,70,719. Deduct it. 25 lakhs minus 6 lakhs. So you'll get 24 lakhs, 32,000. 25 lakhs minus 6 lakhs. 70,000 is 70. Yeah, 70,719. It comes to 18 lakhs. Sorry. 18 lakhs 29,281. So this is for house 1. This is how we do. Is it the same way they given here? Just look at here. What they did.
Yes, ma'am.
Yeah, here what they did, it was, they took the previous year. 2020-21 they have taken here, the index number 280.
But in our textbook, it is given 317 only, ma'am.
Okay. Maybe then you get the same answer what I did, if I'm not wrong.
18,
is it the same answer?
Yes, ma'am. It is.
Yeah, 18 lakhs, some change it has got.
18 lakhs 29,281.
Yeah, 18 lakhs 29,281. Is it the same answer? Now same with the house 2. House 2, what is the cost of acquisition? At what price they have sold? They sold it for 60 lakhs. 60 so here, if you can just look at here. So selling price, whatever they are calling the selling price, it is called as sales consideration. It is not selling price, it's called sales consideration. And we don't have any transfer expenses, so they have not written, but we have to write. Less transfer expenses, nil. So again, you will get 60 lakhs. And this is called as net sales consideration. net sales consideration. And from this indexed cost of acquisition again, and if you just look at your indexed cost of acquisition, the rate, what is the rate they have purchased? 2,50,000. And this was also before 2001. So whenever it is before 2001, all the time remember this point that whenever the house is purchased before 2001, that is 1st April 2001, in that case, we will take fair market value or the cost of asset. Whichever is more, that will be taken as the for the calculation of indexed cost of acquisition. If you look at here, cost of asset is 2,50,000. If you just look at here, cost of asset here is 2,50,000 and market value is 3,50,000. And out of these two, which is the higher one? The highest value is market value. So in this case, we will take market value. So 3,50,000 divided by which year they have purchased before 2001. So 2001 means what I said, we will take it as 100. So 3,50,000 divided by 100 into our previous year index value will be 317. That's what they have did here. 3,50,000 divided by 100 into 317. If you calculate like this, how much it would be, sir? Madam, answer?
Ma'am, 11 lakhs 9,500.
Yeah. So you'll get 11 lakhs 9,500. 11 lakh 9,500. Next, same. If you look at here, cost of improvement. They have done cost of improvement same again for the house 2 times. One is in 2000 for 25,000 and 14-15 for 77,700. And what I said, whatever it is done before 2001, cost of improvement, it will be taken as, it is ignored. No, it will not be taken. And this year 14-15 will be taken for the improvement. Why? Because it is after 2001. So if you look at here again, what is improvement? 77,700 divided by, in which year we did 14-15? So divided by 240 into our previous year value will be what? As index number
317.
Calculate, you'll get the answer. How much answer you get that? Calculate when you?
Ma'am, 1,02,628.
1,02,628. 628. So when you add these two figures, that is, one is 11,09,500 and 1,02,528.
628, ma'am.
Sorry, 628.
Answer is 12,12,128.
Yes. 12 lakh.
12,000. 12,000, ma'am.
12,128. 120, 188. 128. 128. And if you deduct from 60 lakhs minus 12,128. You'll get
47 lakhs 87,872.
Is it the same answer?
Yes, ma'am. Same answer.
47 lakhs 87,872. So this is how we do the income from capital gain. Is it clear?
Yes, ma'am.
Yeah. So now we'll just look at the others. Actually, they should give even exemptions also, but they have, let's see anywhere they given any exemption or not. If they give like that, we'll just check it.
Ma'am, only this type of question will come or some more additions will be there in the question?
No more additions. This is the maximum problem will be coming. And exemption, if they mention in the question, then only we'll give the exemption. See, just now I was telling transfer expenses. That point has been there here in 4th question. You can just look at here. We'll just go through. X purchases a house property for 36,000 on 10th May 1974. So this is the cost of property, that is 36,000. He gets the first floor of the house constructed in 78-79 by spending 80,000. He dies on 12th September 2004. The property is transferred to Mrs. X by his will. So X has died in 2004. He did improvement. He did even the purchased the house. But he transferred his house to his wife, that is by will, writing a will to his wife. Mrs. X means the lady spends 40,000 during 2005-6. This is improvement for renewals or reconstruction of the property. Mrs. X sell all the house property for 10 lakhs on 15th March 2019. Brokerage.
It is mentioned 2022 in my book.
Yeah, that is previous year.
Previous
Okay.
year. Okay.
This is old book. So this is previous year 2022. Brokerage paid by Mrs. X is 2%. The fair market value of the house is on 1st April is 1,10,000. So if you look at here, when the house was purchased, the house was not purchased by her. First of all, the house is purchased by Mr. X, but she has received that house by will. So she has spent some expenses, that is cost of improvement, and she sold for the house, that is for 10 lakhs. So at what price I'm selling the house? For 10 lakhs. Sale price now. So here, sale consideration. Sale consideration is 10 lakhs. Next, what she did, she sold, but she paid some expenses. Brokerage paid. If you can just look at here. Brokerage paid by Mrs. X is 2%.
2%.
2% on what? Whatever the sale value I'm selling that property on that 2%. So my sale value is how much? 10 lakhs. So 10 lakhs into 2%. 10 lakhs into 2%, 20,000. So this is called 9,80,000 is called as net sales consideration. Net sales consideration. Now, as it is a long-term asset, there is no question that it is not a long-term. Why? Because they are purchased in 1974. So now, indexed cost of acquisition has to be done. At what price X has purchased in 1974? For 36,000. Yes, he purchased for 36,000. Now, it is before 2001 it is. It is before 1st April 2001. So whenever it is before 2001, what I said, cost of asset or fair market value, whichever is higher, that will be taken for the indexed cost of acquisition. If you look at here, fair market value of the house on 1st April 2001 is 1,10,000. Yes? Yes, it is 1,10,000. And what at what price they have purchased? For 36,000. Now out of these two, which is the highest one?
Fair market
1,10,000. Yeah. So here it will be 1,10,000 divided by, when they have purchased the house? Before 2001 na? 2001 means what is the index value I will take?
100.
Now what is my previous year index value?
317.
My previous year index value is 317. So if I calculate 1,10,000 divided by 100 into 317, it comes to 3,48,700. Is it right?
Yes, ma'am, it is right.
3,48,700. This is my cost of acquisition. Now comes indexed cost of improvement. See, improvement has been done twice. One is done by Mr. X in 78, 79. And again, Mrs. X also had done improvement in 2005 and 6. So which one should I take here? I will take improvement of 5 and 6. Yes. I will take improvement of Mrs. X on during 5 and 6. Why? Because anything done before 2001 will not be taken. It will be ignored. So here in 5 and 6, she has done an improvement that is 40,000. So 40,000 divided by, in which year she has done? 5 and 6. In 5 and 6, did they given your index number to us? No, they did not given. Yes?
Yes.
Then you should know the table. Please go to the table and let's check it. What is the number given to us?
5 and 6 is 117, ma'am.
117. So divided by 117 into previous year index value is 317.
Ma'am, that was the question, that suppose if
So
they
40.
don't mention, if they don't mention that index number, so
Yeah.
we need to remember all the
So
index
better
numbers.
you take index table paper. No, that's the reason. You take index table paper table along with you. If they allow you, it's better. Otherwise, you can ask them if after going to the hall, if it is given in the question, no problem. If it is not given, you can just ask them to give that table. That would be better. You better take that paper index table.
So they will provide us, ma'am.
So here they may not provide, then you have to nothing but memorizing it.
Okay.
You have to memorize it. There is no other option then. So 40,000 divided by 117 into 317. It comes to 1,08,376.
Yes, ma'am.
Yeah, if you add this and deduct it from that net sales consideration, so it will be 3,48,700. You'll get 4,57,076 out of 9,80,000. You have to deduct it.
5,22,000.
So 9,80,000 minus 57,076. It comes to
5,22,924.
yeah, 5,22,924. So like this method will be coming in the exam.
Okay.
I hope you have understood all. Yes?
Yes, ma'am, understood.
Yeah. So remaining most probably all of the topics would be theory topics apart from this.
Ma'am, one more topic is left, I think. Income from
Yeah,
other
income from other
sources.
sources. Yeah, income from other sources. Just give me a second. Yes. Yes. Yeah. So income from other sources means any income which falls under this head. Is it the screen visible to you all? Yeah.
No, ma'am, not yet.
Okay, it's loading.
Now it is visible, ma'am.
So income from other sources. Here, this is the last head of the income. This is wherever, like whatever, if you have any income from participating in any quiz competitions like Kaun Banega Crorepati, Milevar Kotishwarudu, or any games, puzzles, crossword puzzles. In magazines, they will give us some crossword puzzles, Sudoku. If you do that and send that, you get some prizes in the form of cash or something kind. Or any, if you have the habit of participating in race horses, cars riding, and also lotteries, cards. This all whatever income you get out of these things, that is called as income from other sources. So if you can just look at here, even mentioned in the first page itself, these all incomes, interest on securities. Securities means no, here it is not shares, because whenever you purchase shares, it is called dividend. Securities we call interest, we call whenever we give some loan. On that loan, if we get some interest, that is called interest on securities. Nothing but bonds, debentures. If you are purchasing, on that you will get interest. And dividends, whenever you purchase any shares, yes, whatever that income you get, that is called dividend. Income derived from letting means here, for example, some companies require some equipments, plant and machinery, but they are very small companies or some startup ventures where they cannot afford to purchase those machinery. In that case, they will go for rent basis. So if I am having that machinery and I am giving that machinery for rent purpose to other companies, and out of that rent, whatever income I am getting as a rent, that is called income derived from letting. And sometimes we have subletting. Means, for example, I am staying in a house on rent basis, which is of double bedroom portion. But I thought it's not that much useful for me, 2 rooms, because I'm a single person. So I given again another room for rent purpose. I am a tenant. Again, I am giving another room for another person on rent basis. That is called subletting of income. Family pension, winning from lotteries, puzzles, card games, casino, we will see, yes. All that amount you receive, that all comes under income from other sources. But here for each head we have different type of calculation, and how to treat, what is the treatment, that all is different for each head. So incomes chargeable, if you can just look at here, we have specific incomes, general incomes, specific incomes, whatever just we have discussed, that is interest on securities, dividends, winnings from lotteries, crossword puzzles, races, card games, bettings, other games, or any sort of gambling, speculation in the market, we do trade, stock exchange. Yeah, that all comes under here. And income from letting of plant, machinery, or furniture are not taxable under business. These here, normally they are not taxable under business income. They are taxed here under income from other sources. Letting here, depreciation is different. Here letting means we are giving for rent basis. And next, any amount received from his employer's contribution to any provident fund, or income received from under key man insurance policy, or any gift or money received by an individual or a HUF. And if it is exceeding 50,000, that is taxable under income from other sources. And here general incomes means any fees or commission received by employee from other employer, not from your boss, from other boss. If you are getting, that all comes as income from other sources. If you are having bank deposits or any securities, if you are getting on that interest on bank deposits, interest on loan, and income from a tenant from subletting the whole or part of the house property, remuneration received by a teacher or a lawyer by doing examination work. See, as a teacher, we do some other examination work like valuation of papers, setting of papers. Yes, all that are income from other sources. They are not our salary. Okay, income from royalty, director's fees. So this all comes under the income from other sources. Just you can go through this. It is easy to understand. So interest on securities. See here, securities are again three types. Securities which are exempt from tax, tax-free securities, less tax securities. So here the actually I don't know whether they're given for the calculation purpose or not. Actually securities means what? Not only share, it is not called shares actually. Here securities means this. These are securities exempt from tax. Means if you are investing your amount in this type of securities, your total whatever income you get out of that, that is exempted from tax. That is 12 years national savings annuity certificates, national defense gold bonds, special bearer bonds, treasury saving deposit certificates. So these are all different types of securities. If you are depositing on that and you are getting any interest out of that, if you have purchased some 12-year national savings certificate on any investment, you get interest. If you are getting any interest by this type of certificate, in that case, they are not taxable. They are exempt from tax. Next, again, we have tax-free securities. Means tax-free means they are not tax-free securities. See, that's meaning they have given if you just look at here. Actually, these are not tax-free. Understand? Tax-free means not tax-free, but tax is paid by the issuing authority. For example, I purchase some bonds of government institute. It means whenever if it is a tax-free, the name itself is tax-free securities, I am purchasing. But on behalf of me, tax is paid by the person who has issued me that one. I am not going to pay that. Okay?
Okay.
They are tax payable only, but actual person is not paying that. The authority who have issued, they will be paying the tax. So that's the reason they're called as tax-free security. That's it. So whenever there are tax-free securities, we have a formula that is net interest received into 100 by 100 minus rate of tax. So this is a formula, means gross should be found out. Because here net will be issued. Because I am not paying the tax, but the other person is paying. So on that have to pay it. So that is grossing up, we call it as. Again, under that we have tax-free securities, government securities, commercial securities. So under again tax-free, we have government securities and commercial. Government means presently they are not being issued anymore. If they are also, there is no tax for them. And for commercial, they are not actually tax-free. They have to pay the tax, that is a 10%. 10% rate, it will be charged. So grossing up will be done, the same grossing up, whatever here I said, na? Net interest into 100 by 100 minus rate. Commercial means minus 10. Minus 10 na rate of interest. So 100 by 90. Whatever amount we receive into 100 by 90. That's what they've given here. Nothing new. So if I just look at this question, we'll look at na. Mr. X invested 1 lakh rupees in 8% tax-free debentures of a company, what will be his taxable interest for the previous year? If securities are listed in the stock exchange, if securities are unlisted in the stock exchange. First, we will find out what is the net interest. What is the tax percentage? They said 8%. So 1 lakh into 8% comes to 8,000. That's what they given it. And what I said, whenever it is a tax-free debentures, we will have to gross up. This is called grossing up.
Okay.
This is called grossing up. Okay. Net interest into 100 by 90. So that's mean here they did. Actual amount we received is 8,000 into 100 by 90. That's it. Less tax securities. Less tax securities means here the person, whoever is holding that one, they will be paying the tax. See, out of the amount interest due to security holder, tax has to be deducted by the issuing authority before making payment of interest to the security holder. See, in the earlier case, the authority was paying that. Here, normally we call it not TDS, tax deducted at source. Means before giving only, they will cut your tax amount and give you the remaining amount. If it is 1,000 rupees, 100 rupees is the tax. Your employer or your authority will cut the 10 rupees, that is 100 rupees, and they will give you 900 only. Means tax deducted at source. The interest received by the assessee is the net interest, and the same is to be grossed out by including in the total. So again here we have gross up should be done. For government and listed securities, grossing will be done. Whereas face value is given both in government, in that case we will take rate by 100. There is no grossing up for that type of securities. So most probably I don't expect, because from block 1, if the questions are from each block is 2 questions, then in that case block 1 will be carrying I think 2 or 3 questions. Out of that you have many choice, but if you have any model paper or any previous question papers, and if you just please check that one, how they are giving the pattern of that questions. If they are giving only on from the block 1, or how many questions, do you have any pattern of your question paper pattern with you all?
Ma'am, at the end of the textbook, one model paper is given.
Let me check it then. If I have, I will just check it. No? At the end of the textbook, is it so?
Only
yes,
total income is given. Madam.
Only one paper is given, ma'am, model question paper.
Okay, just can you share the screen if you have? Okay, I think you don't have soft copy. Okay. Please give me a second. I'll just check it. If I have, let's have glance on that one.
Ma'am, one question is given for Karta and HUF. So one question will be given on the topic.
Yeah, I think I think 2 questions from each block. How many questions are there for essay questions?
Ma'am, total 15 are there.
15.
5 questions.
5 questions from each unit? Then no.
I will tell you that, madam. Actually, big questions is 10 marks questions in 5. AB 11, 12, 13, 14, 15.
Okay, each block 2 questions.
Yes.
Each block 2 questions will be given. Each block 2 questions. Okay.
2 questions, but I think it is a total income given. And salaries 5 heads is not.
No, we cannot tell that this only will be given. Why? Because we cannot estimate the mindset of the paper setter. So we cannot say that only this question will be coming for the exam. Just give me a second.
I think it is GST and HUF.
Yeah, that will be totally theory. That will be purely theory.
To prepare that
one problematic question is given that the Karta of an HUF furnish the following particulars of the income of the HUF for the relevant assessment year.
That is block 3. That is block 3, ma'am.
So one question we will get from that, ma'am. HUF.
Yeah, block 3. If you look at here, I think the screen is visible to you. Yes, block 3. You have assessment of HUFs, assessment of firms and of persons, and assessment of companies. So under this Karta, that is whatever is given is assessment of HUF, which is given to you over there. So let's look at that now. Better you'll have that thing also, how to do that.
మేడం ఇది ప్రీవియస్ క్వశ్చన్ పేపర్ ఉంది ఒకటి జనవరిలో సప్లీ రాసిన వాళ్ళు ఉంది
ఒకసారి గ్రూప్ లో పెట్టండి.
Yeah, please better you do na, so that I can share now. Post it in the group. And till he posts that, let's have small discussion what can be expected in the exam and what are the pattern. Because according to the syllabus, if the last unit will be purely theory, that is about GST. So most probably overview of GST implications. So all last unit, that is block 5, is total GST, but in that number of topics are there: appeals, revision, assessment, refund of GST, payment of tax, returns under GST. So fifth unit, fifth block, 2 questions that will be theory only.
మేడం
And
అది పెట్టేసాను గ్రూప్ లో.
yeah, okay, I'm just checking it. I'll just share it now.
And one question is also given about partners. A and B are active partners, C and D are sleeping partners.
Okay. Madam, actually, essay question.
That is third unit only, ma'am. Assessment of HUFs, assessment of companies and firms. That is third part. Block only. That is.
Okay.
Just give me a second. I'm just downloading it.
One question asked from salaries and other is total income. Remaining is theory.
Yeah. That's what. It may be anything because your syllabus is so vast. We cannot expect only this will be coming. Little time. And if you look at the, I think it's a computation of total income. In the meantime, it's opening. Aggregation and income set off and carry forward. If it is given theory, it is easy. But if they give you calculation part, then you should be able to write which part is set off, means how much amount, if it is any loss, till how many years it can be carried forward. And how to carry forward and how to write off that. Set off means whatever loss we are getting. For example, I'm having 2 types of business. If I'm carrying on 2 different types of business, like speculation business, but different assets or different things I'm involving it, is it possible to set off that loss of one business in from the other business or not? That all comes under the block 2. And just let me give some time. It's not opening the question. Yeah, I got. Yes, I think it's visible to you all.
Yes, madam.
So if you just look at here, okay, you have section A 5 to 4. So what are the tax rates applicable for the individuals in the current assessment? It's very simple. If an individual who are less than 65 years, exemption limit is 2,50,000. From 2,50,000 to 5 lakh, it is 5%. 5 lakh 1 rupee to 10 lakhs, it is 20%, and above 10 lakhs, it is 30%. That is the first one. This is what our tax rates applicable. And here they have given gratuity. How to calculate the gratuity they have given? A service, he has served the organization for 18 years and 9 months. Their pension are 5,000 per month. And September 20, she got 2/3 pension committed and received 2,20,000 and compute her taxable pension. So, and she is a non-government employee. So whenever there is a non-government employee, we have a provision. Actually, gratuity for government employees is totally exempted from tax. For non-government employees, again, we have two things. If the employee is under Payment of Gratuity Act 1972, if it is covered, we have some rule. If the employee is not covered under Gratuity Act 1972, we have some other rule. Out of that 3 points, whichever is less, that will be exemption. That is based on the amount, actual amount received. So pension they received is 2,20,000, and number of years of service put on. So if you look at your service is 18 years, 9 months, and the pension is 5,000. And if you calculate those 3 points, whichever is less, that will be given as gratuity exemption from tax. And what is family pension and how it is tax treated? So this comes under the, just now we have discussed income from other sources. So this comes under income from other sources, family pension. Next, what are speculation losses? This was block 2, just now I'm discussing, that is set off and carry forward. If you have speculation loss, so how it can be set off? If so, how? So again, we have rules under there. Different means we have like business also, again we have, if it is a long-term asset or long-term gain or short-term asset, how to set off all that. That is a theoretical part you have to go through. And when it's a self-occupied house, treated as deemed to be let out. Means sometimes in the question they will give both houses are self-occupied. And what we did, one house we have assumed that it is a let out house and we have calculated. So whenever you are treating self-occupied as a deemed to be let out house, explain the related provisions under the Income Tax Act. So what we will do, whenever we are assuming self-occupied as let out house, we will treat it as let out house only. We will do all the procedure like gross annual value. If gross annual value is not given, whatever municipal value or whatever value given, that only we will take it as gross annual value. And we will deduct all the local taxes. And same provisions we will do, that is interest on loan, standard deduction, or any pre-construction interest. And also what we will do, if one house is deemed to be let out as another house is self-occupied, two situations. And we will compare two situations, whichever is the best one, that we will take it as more income. If you are getting from that house, that will assume as self-occupied. Whichever house we are getting less income, that will take it as let out house. Next, in the previous year, a minor had the following incomes in which parents. So this will be added in clubbing, aggregation of total incomes it comes, that is unit block 2 it will come. So in which parents income should they be included? So what happens if minor is earning some income? It should be added in mother income or father income. So 40,000 as interest from bank deposit gifted to him by his father. So his father has given to his child. Yes, so in which parents income it should be included? Is it mother income or father income? Always remember, whoever income is more, in that it should be added. Whatever minor is getting income, whoever income is more, in that minor income will be added. So if you look at your minor's father income is 4,50,000, mother income is 5 lakhs. So it should be added to the mother income and you have to calculate the tax liability. Next, explain the provisions of deduction under section G, 80G. So it is a theory. So it will come under block 3, HUFs. So theory answer, we have deductions for HUFs that has to be written over there. What do you understand by reassessment? This comes in block 4. Block 4 it comes. Reassessment and refiling, all that comes under there. How to file the e-tax returns. Describe the taxable events. So these two comes under GST. And when you talk about essay questions, they given salary problem, yes. And if you look at your, you're required to ascertain income from salary if is a non-government employee residing in Hyderabad. Salary from employer A in Mumbai 50,000 per month received from April to July of the previous year. Salary from employer B in Chennai. So 3 different employees they have given. Bonus received from employer A, 2 months salary. Commission received from employer B. So he's having 3 employers. A in Mumbai, B in Chennai, and C in Hyderabad. And commission received from employer B, 1 month salary. The employer at Hyderabad contribute 12% salary to RPF. So this is only about B. House rent allowance 55,000 per month as given by his employer at Chennai. Mr. Yoganand paid rent rupees 15,000 per month during his stay at Chennai. The employer at Mumbai paid hostel allowance at the rate of 500 per children per month. Mr. Yoganand's 3 children. Assume the salary is paid on the last day of month in all cases. So if you just look at here, he is not fixed at one place. See, he received April to July. Yes, April, May, June, July, 4 months salary. So each month 50,000. 4 months it comes to 2 lakhs. Means your salary is not to be given directly. You have to calculate. That is the main problem in this question. Next, in Chennai, he was there from August to December. So he's receiving 40,000. So August, September, October, November, December, 5 months. 5 4 is 20. So again, 2 lakhs. Now again, in Hyderabad, he was from January. So January, February, March. Because our year starts from 1st April 2001 to 31st March 2002. So 3 months. 3 months, each month 60,000. So 6 is 18, 1,80,000. So when you add this 3, you will get 5,80,000. So my basic salary is, I said na 3 Roman numbers. So under Roman number 1, salary is 5,80,000. Next one, he received bonus. Bonus is how much? 2 months salary. Bonus is 2 months salary. From whom? Employee A. Employer A. Employer A was giving how much salary? 50,000 per month. So 2 months means 1 lakh. So bonus is 1 lakh. Next, commission received from employer B. So employer B is giving how much salary? 40,000 per month. 1 month salary is commission. Commission received by employer B, 1 month salary. So commission is 1 month means B's 1 month salary is 40,000. So commission is 40,000. Salary 5,80,000 basic salary. Bonus 1 lakh. Commission 40,000. Employer at Hyderabad contributed 12% of salary to RPF. So RPF should be how much? 12% only. He contributed 12%. So it will not be taken. If anything contributed more than 12%, then it is taxable. We have discussed earlier. 12% more than, then only it is only 12%. So it will be not taken. Next, house rent allowance. How much is giving? 5,000 per month. Where it is giving? Chennai. So 5,000 per month means 12 months it comes to 60,000. So HRA is receiving is how much? 60,000. But is it totally taxable? No, we have a rule. Under section 10, whichever is less, that will be deducted and remaining will be taxable. So now what is doing? How much? Mr. Yogananda paid rent is 15,000. So first rule is actual HRA received. First point. Actual HRA is receiving is 60,000. Now, where he is staying when he received HRA? He is received in Chennai. Chennai is a metropolitan city. And whenever it is a metropolitan city, 50% of salary is taxed. 50% of salary. Here, salary means what? Again, for HRA, we have a formula. Provision. Salary means basic pay plus DA if it is a part of salary plus commission on turnover. Basic pay, DA, part of salary, then only we will take, plus commission on turnover. So basic pay is how much? Basic pay here we got is total 5,80,000. So 5,80,000 Do we have DA? No, DA is not given in the question. And commission on only commission is given, but commission on turnover is not given. Commission on turnover means nothing but commission on sales. Sales is not given anywhere in the question. So that is also not there. We have only basic pay, that is 5,80,000. 5,80,000 into 50%. It comes to 2,70,000. It comes to 2,70,000. 50%, no? Is it 70? No. 2,90,000. 2,50,000. Yeah, 2,90,000. Sorry. 50% means 2,90,000. Now, third point is rent paid minus 10% of salary. Rent paid minus 10% of salary. How much rent he is paying in this question? He is paying 50,000 per month. Mr. Yogananda paid 15,000 per month. So rent paid is 15,000 minus 10% of salary. Salary means what we got? 5,80,000. So 5,80,000 into 10%, it comes to 58,000. And always remember, if you look at here, 15,000 minus 10%. 10% of salary should not be more than rent paid all the time. And if you look at here, rent paid is less than 10% of salary. So you'll get a negative figure. You'll get here 43,000 minus 43,000.
15,000 into 12 months, madam. Actually, the rent paid per month. Rent paid 15,000 is per month. 15,000 into 12 minus 10% of salary.
Yeah, rent paid per month is given
15,000.
Yeah, rent paid. Yeah, 15,000 into 12 months.
12 months minus 10% of.
Yeah, yes. Sorry. 15,000 into 12. It comes to 1,80,000. Yes? Is it so 1,80,000?
Yes.
Yeah. 1,80,000 minus 58,000. 1,22,000. 1,22,000. Now out of these three, 60,000, 2,90,000 or 1,22,000. Out of these three, whichever is less. Whichever is less, that will be exempted. And here 60,000 is exempted. So whenever I write allowances under allowances HRA, 60,000 minus 16,000, then it is not taxable. It is zero. There is no HRA. Actual HRA received minus least of the following. And if you look at your list of the following, HRA is, again it is 60,000 only. So 60,000 minus 60,000, there is no HRA then. It is not taxable. Next we have, the employer at Mumbai paid hostel allowance, 500 per child per month. So what is the rule for hostel allowance? How much is exempt? Is it 300?
Checking.
It's 300 only, to my knowledge. Yes, it's 300 only. Education, it is 100 per child, and hostel allowance 300 per child. So hostel allowance will be, he is receiving how much? 500 per child. And how many children is receiving? 3 children. So first what we will write under allowances, children hostel allowance, 500 into 3, he given, employer is given, into 3 into 12. Per month is given now. 500 per child for 3 children into 12. So 500 into 3 into 12. It comes to 18,000. But how much is exempted? It is exempted 300 rupees only. Though it is employer has given 18,000, but total 18,000 is not taxable. Less limit 300 per child. Only for 2 children it is exempt. 300 per child for 2 children for 12 months. 300 per child for two children, that too for 12 months. So 300 into 2 into 12. It comes to 7,200. So 18,000 minus 7,200. The difference would be 10,800. So hostel allowance is taxable amount is 10,800 is the taxable amount. Next one. Assume that his salary is paid on the last day of the month in all cases. So add this, you'll get total salary or income from salary. From that is gross salary. So here 5,80,000, 1 lakh, 5,80,000 plus 1 lakh plus 40,000 plus 10,800. So we'll get 7,30,800. This is called gross salary. This is called gross salary. From this, we have first deduction, that is standard deduction 50,000, and we don't have any other deduction. So if we deduct that 50,000, you'll get 6,80,800. That is income from salary. Income from salary. This is how we calculate the salary. Next. What are the rules to determine the residential status of this is residential status, what we have discussed. It's a very simple part. Residential status. How do we decide residential status of an individual normally?
182 days.
Yes, 182 days in the previous year, or 60 days or more, and 365 days out of 4 preceding previous years. That is for individual. So he's asking both individual, HUF and company. So you'll be writing that basic conditions he should have satisfied. For individual, 182 days or more should have stayed in the previous year relating to the previous year to call him as a resident, and or 60 days or more and 365 days out of 4 preceding previous years relevant to the preceding previous year. Next, additional conditions. 2 years out of 10 preceding previous years relevant to the current previous year, and 730 days out of 7 previous years preceding previous years relevant to the current previous year. That is for the individual. Next, HUF, how do we determine his residential status? And also you can write this for individual. If he satisfied any one basic condition, we call him as resident. If he satisfies one basic condition and one additional condition, we call him as resident but not ordinary resident. If he is satisfying one basic condition and both additional conditions, we call him as resident but ordinary resident. That also you can mention. For HUF, it is clear that HUF means his residential status is determined by the residence of Karta. If Karta staying in India but all business activities are done either partially or wholly from India, then it is called resident. And to call him a resident but ordinary resident, same additional conditions which are applicable to individual, that only applicable to the HUF also. And for company's residential status is determined by the management of that company, control and management from where it is done. On the basis of that, residential status of the company is done. Now here 70 to 74, that comes under block 2, setting of losses. Whatever just now I was discussing, we will have losses, that whatever loss comes, how to write off that. This is a theory answer. Next, total income, gross total income. So all here, if you look at here, he has given income from house property, he given income from business, and this is nothing but the other incomes, income from other sources, profits from speculating in gold, loss from speculating in silver, loss from, if you know the set of carry forward, you can write this. This is what I was telling. If you look at here, he is getting profit from speculating business in gold and loss from speculating in silver. Next, speculation business brought forward from last year. This is income from other sources. And here we have income from capital gain. Short-term capital gain, we have 20,000. Long-term capital gain, 10,000. Short-term capital loss, 5,000. And always remember, long-term capital loss cannot be write off from the short-term capital gains. It cannot be written off. It can be carried forward till you get long-term capital gain. And business loss of the previous year. So we have to add all these losses to be deducted to find out the gross total income. Next, this is block 3, HUF. They have given theory. What are the provisions of section 44AA with regard to tax audit of HUF and assessment procedure of a partnership firm? So mostly they'll give theory part from the 3rd, 4th and 5th blocks. What is a permanent account number? What are the provisions regarding its allotment? What is recovery of tax, GST? That's it, I think so. So only I think the problematic part they'll give from the salary and the most probably very rare case gross total income. Otherwise they'll give, if you are going thorough with the set off and carry forward of losses, it will be benefited to you. Is it clear? And I hope you'll do best in the exam. All the best for your exam.
Thank you, ma'am.
Thank you.
Set up and carry forward is you are not
theory. Yeah, shall we go ahead? No, I don't have any objection. I'll take. I don't have any objection. Let's
ma'am,
take.
Is it possible for you to take any other class next week, ma'am?
Whatever the schedule is given, according as per that, I'm going.
Okay.
So it's not in my hands. It's not in my hands. Let's see now that set off and carry forward.
Yes.
Yeah, please. Just give me 1 minute. I'll share the screen, set off and carry forward. Computation of total income. Yeah. Yeah, I'm sharing the screen. Yeah, is it? Can you see the screen?
Yes.
Yeah. So again, set off, we have 2 methods. One is set off under the same head, set off income against the other head. See, as we know, we have 5 heads of income. Yes, that is income from salary, income from house property, income from business and profession, income from capital gains, and income from other sources. If you are setting, for example, I am having 2 houses and I'm getting income from 2 house properties. But from one house property, if I'm getting loss and the other house property, if I'm getting income, is it set? Can I write off between, for example, one house I'm getting 80,000 profit, the other house I'm getting loss from that house, that is 40,000. Then can I write off that loss from that house or not? That is called set off under the same head. For example, I have only loss from the self-occupied house and I don't have any other incomes under the same head. Can I write off this loss from other income or not? That is income against other heads. So let's look at here. Set off under the same head. If the net result for any assessment year in respect of any source falling under head of income is a loss, the assessee shall be entitled to have the amount of such loss against the income any other source. So how to do that? In that we have 4 points which can be set off. Okay. Loss from speculation business. Just now we have read speculation gain from speculation of gold business. Loss from speculation of silver business is given just now in the previous question for whatever we discussed. If you are getting any loss from speculation business, speculation in trade market or stock market, if you are getting any loss from that type of business, it cannot be set off against any other income of other business or profession. For example, I am doing one speculation business like share market or stock market, where we do not know whether when it will increase or when it will fall down. If I am involved in that type of business, and if I get any loss from that type of business, and apart from that, if I have any other business or I'm a professional also, yes, and from that, if I'm getting any other income, this loss cannot be written off from that. I cannot remove this loss from that incomes. And how to write off this loss then? This loss can be set off only against the income from another speculation business only. See, just now we have seen speculation gain from the gold business. Am I right? If I'm not wrong, is the same thing? Just give me a second. Let me check. I think so. That is the same thing. Just now we have saw. I'm like looking the question. Yeah, what they have given. Yeah, profits from speculating in gold and loss from speculating in silver. So what he was telling, the same he was telling, that was whatever loss I'm getting from that type of speculation business, only from that type of speculation gain only have to write off. Means I cannot write off from normal business. Speculation in gold, speculation in silver. In gold, I'm getting profit and silver, I'm getting loss. This silver loss can be written off from the gold loss. Only that type of business only. Next one. Long-term capital loss cannot be set off. This was I was telling just now when I was discussing the question. Long-term capital loss cannot be set off against short-term capital gain. Then how to set off that loss? This loss can be set off only against long-term capital gain only. This same given in the question just now. See, is the question paper visible to you? Yes? Am I
Yes,
audible?
ma'am. Yes, ma'am, it is visible.
The question paper.
Yes, ma'am, it is visible.
Yeah. See, if you just look at here, profits from speculating in gold, loss from speculating. So these both are speculation business only. So this loss 50,000, whichever I got, I can deduct it from 70,000. So now I will have speculation business profit is 20,000 only. And this loss will not exist here. This will be removed. How? By deducting it from the profit. And same short-term capital gain is 20,000. Long-term capital loss is 10,000. What I said, this long-term capital loss cannot be written off from this short-term capital gain. This can be written off only from long-term capital gain only. And how it will be treated? It will be treated as loss only. Whenever you do the problem, it will be shown as loss only. It cannot be written off until we get any other long-term capital gain. So long-term capital loss cannot be set off against long-term, short-term capital gain, but this can be set off only against long-term capital gain. Next, loss from the activity of owning and maintaining race horses. So this is also income from other sources. It comes whenever you are having your own race course, you are maintaining it, you are looking after that, and you got loss from that type of income or that type of source. So how to set off? It can be set off against income from owning and maintenance of horse races only. So whenever you get loss from that type of business, horse races and maintenance, you can set off, or set off means you have to match it up. Okay. Can be done only by getting the income from that type of income source only, and not against any other incomes under other sources, because income from other sources, we have read various things. Yes, lottery wins, puzzle words, crosswords, family pension, interest, dividend, interest from securities, that all comes under income from other sources. But though it is also comes from income from other sources only, I cannot write off. Why? Because this can be write off only from that type of income only. Next, loss from an expected exempted source of income. any income which is exempted source cannot be set off against any taxable income. See, that income is an exempted one, but we got loss from that type of income. That cannot be set off against any, actually we have another income which is taxable. So I cannot deduct it from that taxable income. These are under the same head. Next, we will talk about a set off against incomes under the other heads. So is it possible to set off my income from loss from business from the income from profession? Is it possible or not? Let's see that. If after setting off a loss under the same head of income, there still remains some loss. These all are same heads. See, speculation only you have to set off. Long-term capital loss, you have to set off against long-term capital gain only. So these are under same head. If after setting off a loss under the same head of income, there still remains some loss. For example, speculation of gold is 50,000 gain. Loss from speculation of silver is 80,000. Though I deduct it, still I will have a loss of silver business is 30,000. Why? Because gain is gold is 50,000. Loss from silver is 80,000. If I deduct 50,000, so still I have a loss of 30,000. How to do that? That is what they are explaining here. If after setting off a loss under the same head of income, there still remains some loss, the remaining loss shall be set off against the income under any other head. So this can be set off after deducting same head. If any still loss is there, then we'll go for deducting it from other head. However, the following losses cannot be set off against any income under other heads. They are speculation losses, loss from activity and owning, maintaining resources, loss under the head capital gains. Any loss is not allowed to be set off against winning from races, lotteries, etc. So these losses, though after we did all these changes in the same head, still if any loss is left over in this type of heads, that cannot be set off against any other income, whatever it may be. It cannot be set off against any other income. It has to be done in the same that only. Next, we have speculation loss. Losses in respect of speculation business can be set off against only profits and gains of that type of business only. That is what they're explaining here. Next, losses from the activity of owning, and the same point they're repeating here. It cannot be set off. So how to do that? Losses from the owning of activity or maintaining resources in the assessment year, set off only against same income, not against any other income. Loss from business or profession. Any loss from business other than speculation or profession can be set off against any other income for that is not falling under the same head, as well as under the head of income. Anywhere you can write off, except speculation business, you can write off it with any other thing. Next, we have capital losses, short-term and long-term. Long-term has to be set off against long-term only. But short-term losses can be set off against short-term capital gain as well as long-term capital assets also. You can just look at here. Short-term, such losses can be set off against the gain from any other short-term capital asset or long-term capital assets also. But long-term can be done only from long-term capital assets only. Next, from losses of lottery, crossword puzzles, gambling, card games, or betting. These losses cannot be set off against any income. They cannot be set off. That should be carried forward. Loss of possession of persons or body of individuals. These are intra-head, we call intra-head set off or inter-head set offs. That were setting off. Means how to clear that losses, how to get it to the profit, that was set off. Now it is carry forward. See, after trying to deduct it or trying to get it to positive figure, still there were any losses. How to do that? How should I show? To how many years have to show them? Till how many years have to carry forward? So that is called carry forward and set off of losses. So for example, if you remember the income from house property when we did, we were having one deduction, pre-construction interest. Yes? Or pre-construction loan taken for the construction of the house. Whatever the loan that we have taken on that interest, we were trying to show it of how many years? Yes, I'm audible.
5 years.
So how many years we were trying to set off that interest on pre-construction loan taken? We were showing it for 5 years. Why? Because in 5 years it will be closed off. So similarly, if the losses cannot be set off against under the same head or under different heads in the same assessment year, we are unable to set off that one. So it can be carried to the subsequent years. If it is can be carried to the subsequent years, in how many years it can be carried forward? That is what here given. If it is a house property, business loss, speculation loss, capital loss, how it can be carried forward. Carried forward and set off of house property. So whatever loss you get from the house property, it can be first tried to be set off from intra-head incomes. If it is not possible, still amount is left over in the same assessment year, then that will be carried forward for 8 years. So till 8 years, it can be extended, then it will be closed. And maximum amount should be 2 lakhs for any assessment year. Next, carry forward and set off of business losses. So again, business losses, we have business losses can be adjusted only from business income and business in respect of which a loss is incurred may or may not be continued. Means some business will be continued, some business will not be continued. For example, if you want to adjust from the business income, again, this also for 8 subsequent years, it can be carried forward. And after that, it cannot be shown to set off it. And order of set off. Whenever you want to set off any loss, it has to be done like this. First, current year depreciation. Next comes capital expenditure. Next comes carried forward of business or professional losses. This is the sequence you have to carry forward. Then unabsorbed depreciation, unabsorbed capital expenditure, that is on scientific research. This is on family planning. Then return of losses. Then we have carry forward and set off of speculation loss. How to carry this? This is for 8 assessment years, it will be fully absorbed, and 4 assessment years means if you are having any other loss instead of 8, you can carry it for 4 assessment years also. Next, carry forward and set off of capital losses means like income from capital gains, that is the that chapter. This also can be carried forward for a maximum of 8 years, can be set off for the income loss from the capital gains. Next, carry forward and set off of loss and account of owning and maintaining race horses. So this also can be carried forward for 4 subsequent preceding years. That can be carried forward. So, and additional point, these are the filing of return, this can be done. So most probably this will be come for the theory part or either the problematic part. Okay. So I hope we have done with the class because I have taken 1 more extra also. All the best for exam. If any queries or any doubts, you can, I'm open to your questions.
Okay.
Okay. Thank you, sir. Thank you.